AM Best has released the latest edition of its EMEA benchmarking report, offering fresh insight into credit quality trends across the region and highlighting recurring areas of weakness among rated insurers. The report examines rating movements, balance sheet strength, and the evolving expectations around enterprise risk management. Joining me from AM Best London office is the report's author, Ben Diaz-Clegg, Associate Director in Analytics. And Ben, AM Best's previous edition of the report was in 2024. Can you describe one or two of the main differences that you observed when you prepared the new edition?
Sure. Okay. So if we think back to the previous report, one of the important subjects that we called out was the state of the economic and political environment around the world. If you think back to when we wrote that, we were just coming out of the pandemic. Inflation was at record levels for several decades, at least in more mature markets, and as a consequence of that, central banks were increasing interest rates extremely rapidly, and ultimately what this meant for the insurance market was quite damaging implications for the value of their investments. We can now move back to present. We've seen those investment valuations come back to par as those bonds, for example, have reached maturity, and also subsequent reinvestment at much healthier interest rates. I'd say a second material change, if you want to call it, between this edition and the previous one is where we are in the market cycle. So as we know, the rate adequacy, particularly in the reinsurance space, is extremely healthy. Some would say it's just reached, if not past, its peak, whereas sort of 2 or 3 years ago at the previous report, we were at the beginning of that journey. So underwriting margins are simply a bit healthier than they were back then.
The report notes that there were an above average number of rating changes in 2025. These were primarily centered on the balance sheet building blocks in AM Best credit rating methodology. What factors underpin these?
Yeah, that's correct. So what's interesting is actually the dynamics outside of just the numbers of rating changes. So they were overwhelmingly positive changes, right? And really the reasons for this are largely thanks to the factors that I mentioned in answer to the previous question, right? So as I mentioned, economic conditions are much more stable. We've seen lots of insurers, their bonds have reached maturity, so they didn't necessarily have to sell those and realize those market value losses that I mentioned. So as I said, unrealized losses coming back to par, and also reinvesting in much healthier interest rates. So we've kind of had a couple of years now of very healthy investment returns. And again, thanks to that hardening of the underwriting cycle, where we're seeing now a period of insurers achieving excellent underwriting results. So you sum these things together, and effectively we're seeing capital adequacy improving, right? Organic capital generation has been excellent, and therefore we've recognized that in balance sheet strength assessments of many companies that we rate.
In the report, AM Best notes that it expects companies to improve their enterprise risk management approach constantly. What can be the implications for an insurer if it fails to do so?
Of course. So I think what a common thing that you'll often hear analysts at AM Best say is the risk environment is always changing, right? And I mean, if we think about what's been happening over the last week in the Middle East, is a pretty good example of that. So really, all this statement is getting at is companies need to continuously evolve to be able to manage and mitigate the risks that they face, and the risks that what's going on around the world can pose on them, right? And those companies that are unable to do so, you would expect over time would start to suffer as a consequence. Now, this can obviously come in many different ways, but at the end of the day, it can reach a point where a company's credit quality becomes diminished as a consequence of not keeping up with the risk that they face.
That was Ben Diaz-Clegg, Associate Director Analytics at AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.